Have you ever thought about investing in Chevron? An intriguing question to kickstart our journey today. As one of the leading players in the oil and gas industry, Chevron has established a solid reputation over the years. With a strong global presence and a robust business model, this industry giant has piqued the interest of many investors. So if you're looking for an investment opportunity that could potentially add value to your portfolio, it's time to consider why Chevron might be an excellent addition to your investment portfolio. Chevron, an American multinational energy corporation, stands among the world's leading oil and gas companies. But what exactly does Chevron do, and how does it make its money? Let's delve deeper into its business model. Chevron operates in three main sectors: upstream, downstream, and chemicals. The upstream sector involves exploration, development, and production of crude oil and natural gas. Chevron's upstream operations span the globe, from the oil-rich sands of the Middle East to the deep-sea drilling off the coast of Australia. The downstream sector, on the other hand, refers to the refining of crude oil into finished products like gasoline, lubricants, and jet fuel. Chevron's downstream operations also include marketing and distribution, which is why you might see Chevron-branded gas stations in your neighborhood. Lastly, the chemicals sector. This is where Chevron produces and markets a range of petrochemicals for industrial use. These products are often used in the manufacture of plastics, synthetic fibers, and other common goods. Now, a quick trip down memory lane. Chevron's history dates back to the late 19th century, when it was part of the Standard Oil Company. Over the decades, Chevron has weathered economic downturns, oil price shocks, and geopolitical conflicts. It has grown through strategic acquisitions, such as the purchase of Texaco in 2001, which expanded its reach significantly. Today, Chevron is not just about oil and gas. It's also investing in alternative energy sources and technologies, such as biofuels and carbon capture, to ensure it remains a key player in the energy sector in the years to come. Chevron's diverse operations and long-standing history have made it a staple in the energy sector. But how does it fare in terms of financial health? And what does it mean for investors? Stick around as we explore these aspects in the next segment. Now let's delve into the financial health of Chevron. To understand the financial fortitude of a company, it's essential to look at some key metrics. Let's begin with Chevron's revenue. Over the past decade, the company has demonstrated a remarkable ability to maintain steady revenue, even in the face of fluctuating oil prices. This stability is a testament to Chevron's robust business model and diversified income streams. Moving on to net income, Chevron has consistently posted positive figures, even during industry downturns. This resilience is due to careful cost management and strategic investments that have paid off handsomely. Now let's look at Chevron's debt levels. While the company does carry some debt, as is typical in this capital-intensive industry, it's important to note that Chevron's debt-to-equity ratio is relatively low compared to its peers. This indicates a conservative approach to leverage, which can be a positive sign for risk-averse investors. But perhaps the most compelling aspect of Chevron's financial health is its cash flow. The company has a proven track record of generating consistent, robust cash flow. This is crucial, because cash flow is the lifeblood of any business, and it's what allows Chevron to invest in growth, pay down debt, and, most importantly for our dividend hunters, sustain a generous dividend policy. One more thing to note is Chevron's return on equity. This metric gives us a glimpse into how effectively the company is using its invested capital to generate profits. Chevron's return on equity has been consistently high, indicating efficient capital utilization. All these factors work together to paint a picture of a company with a strong financial backbone. Chevron has demonstrated its ability to weather economic storms, keep its debt manageable, and generate reliable cash flows. These are all signs of a company that's built to last, and they're part of why Chevron has been able to maintain its status as a dividend aristocrat. Chevron's strong financial health is one of its key strengths as an investment. What makes Chevron particularly attractive to investors is its status as a dividend aristocrat. Now you might be wondering, what exactly is a dividend aristocrat? In the world of investments, a dividend aristocrat is a company in the S&P 500 index that has increased its dividends for at least 25 consecutive years. This elite group of companies is known for their financial stability, reliable returns, and commitment to rewarding shareholders. So, how does Chevron fit into this category? Chevron has a rich history of consistent dividend payments that goes back more than a century. In fact, Chevron has been increasing its dividends for over 30 years straight. This impressive streak shows Chevron's commitment to returning capital to its shareholders, even in times of economic uncertainty or volatile oil prices. But Chevron's status as a dividend aristocrat isn't just about the length of its dividend streak, it's also about the stability of its dividends. Chevron's ability to maintain and grow its dividends even during industry downturns speaks volumes about its financial health and resilience. This stability is a testament to Chevron's strong business model, efficient operations, and prudent financial management. Furthermore, Chevron's dividend yield has consistently been higher than the average of the S&P 500. This means that Chevron's dividends provide a higher return on investment compared to the average S&P 500 company. So if you're an investor looking for consistent and high-yielding dividends, Chevron's track record is hard to ignore. To sum it all up, Chevron's status as a dividend aristocrat is a testament to its financial strength, stability, and commitment to its shareholders. It's a sign that Chevron is not just a company that has survived the ups and downs of the market, but one that has thrived and consistently rewarded its shareholders along the way. For dividend hunters, Chevron's consistent and growing dividends make it a compelling pick. But no investment comes without risks, and Chevron is no exception. Now let's dive into some of the risks and challenges that Chevron faces. First and foremost, the volatility in oil prices. Chevron's revenues are heavily dependent on the price of oil, which can fluctuate wildly based on economic conditions, geopolitical events, and even the weather. When prices are high, Chevron's profits soar. But when they plummet, so too does the company's bottom line. This volatility can make it difficult for investors to predict Chevron's future performance, adding a layer of uncertainty to the investment. Next, let's talk about regulatory risks. As an oil and gas company, Chevron is subject to a wide range of regulations, from environmental rules to safety standards. Any changes in these regulations could potentially impact Chevron's operations and profitability. For example, stricter environmental regulations could increase Chevron's operating costs or limit its ability to conduct certain activities. Similarly, if Chevron were to experience a major safety incident, it could face hefty fines and reputational damage. And then there's the elephant in the room, the transition to renewable energy. As the world moves toward cleaner, more sustainable energy sources, oil and gas companies like Chevron could find their traditional business models under threat. Chevron is already investing in renewable energy, but it's still a small part of their overall business. The company will need to navigate this transition carefully, balancing its existing operations with the need to innovate and adapt to a changing energy landscape. Finally, it's worth noting that Chevron operates in a highly competitive industry. The company faces stiff competition from other oil and gas giants, as well as from companies in the renewable energy sector. This competition can put pressure on Chevron's margins and market share, adding another layer of risk to the investment. These challenges, while significant, are not insurmountable and are part of investing in the energy sector. The key for investors is to keep these risks in mind when considering an investment in Chevron, and to balance them against the potential rewards. So, is Chevron a good investment for you? Let's revisit what we've explored today. Chevron's robust business model is built upon a stable industry, and it has proven its financial health with consistent performance. It's a dividend aristocrat, which means it has a history of not just paying dividends, but increasing them over time. This could be an attractive point for those of you looking for a steady income stream from your investments. However, it's not all sunshine and rainbows. The energy sector, especially oil and gas, is facing significant challenges. The transition to renewable energy sources, regulatory pressures, and fluctuating commodity prices are all factors that could impact Chevron's future performance. Like any investment, Chevron comes with its own set of risks and rewards. It's crucial to consider these factors and how they align with your personal investment goals and risk tolerance. Remember, investing is not about following the crowd, but about making informed decisions based on thorough research and analysis. And that's what we're here for, to help you navigate the complex world of investing, one step at a time. If you found this video helpful, don't forget to like, subscribe, and share it with your fellow investors. Stay tuned for more investment insights. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only, and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.